Hi, welcome to this video. My name is Ajit Guman. I'm the founder and CEO of Monetizely. I want to talk about the impact that pricing has on fundraising. When you think about fundraising, what metrics come to mind? Product market fit, user growth, revenue numbers. But one of the most overlooked factors in securing a strong fundraising round is actually pricing strategy. And I've worked with so many SaaS and generative AI companies now. And most often, what I find is founders are underpricing. A lot of people who fail at fundraising, they admit we should have looked at our pricing model more. So, I want to talk about how a strong pricing strategy impacts the metrics investors care about. I want to give you a few anecdotes of what investors said, some success stories, and what you should do. So, what are the metrics that matter? What is pricing going to drive for you? Let's take a look at this one by one. The first, this one is obvious, monthly recurring revenue, right? Even a small increase in pricing impacts your revenue a lot. In fact, research by Bessemer Ventures and OpenView partners have indicated a 12 to 20% median increase in revenue from a pricing project. But this could be as high as 80%, and some of my own projects have had that high of an impact. Podpage is a good example of a company that when they increased pricing by 29%, they saw an immediate ARR jump with no churn and no customer even questioning price. So underpricing is a question. Net dollar retention. Now in today's day and age, investors want to see a net dollar retention number above 115%. Below 100% is a question. Every increase in price, every price increase has a consequent NDR increase impact. And so look at NDR. Then number three, gross margin. Pricing is impacting your gross margin. Now, average benchmarks are 70 to 80%. Many companies are more than 85% in gross margin. Generative AI companies maybe not be. So it's important for you to keep a close eye on gross margin, because if you have high gross margin numbers, investors know that you have a lot of headroom, right? And this can be a reason for you to have a high valuation. And companies with low gross margin are like services companies, and they don't have good valuation multiples. Next, free cash flow. In this economic environment, cash is king. If you are using something like a usage based model where cash is coming in much later, that might not be valued that favorably in today's environment. Now look at Datadog. Datadog is a company that by the time they reached Series B, they were profitable and they were free cash flow profitable, and they had one of the biggest IPOs in history. So it's important. This is a metric that's important. Then finally, CAC payback period. If you have pricing that works, if you are monetizing well, then your CAC payback period may be 5 to 8 months compared to the average 15-month period for other companies. And so these are some of the metrics that having a good pricing strategy, as well as more importantly, what good pricing structure is going to impact, leading to a good valuation by investors. Now that we understand a little bit about metrics, let's talk about how investors are evaluating your pricing model during due diligence. What are they looking for? When they scrutinize your pricing, they're looking for a few factors. Number one, they're looking for your monetization strategy and overall revenue model. They want a clear explanation of what are you charging for, how you charge for it, and why that aligns with your value proposition. Not having a pricing strategy, which many companies still are doing things ad hoc, raises a question. Second, what is the fit between your pricing model and value? When your customers are successful, does your pricing metric enable their success, or is it disjoint from their success? Third, your discounting practices. Are you doing ad hoc discounting, or do you really have a policy that you follow? If you have a policy, that's good. If you don't, that means you may not have pricing power. Finally, scalability and flexibility. If your packages are scalable, if your pricing metric is scalable, that will indicate to customers that you have expansion potentials, that your NDR is sustainable. Here are some real world success stories of both from a fundraise environment as well as a public market outcome perspective. Number one, Jasper is a Gen AI content platform that chose a usage based tiered subscription model. And they were so successful with this pricing strategy that within 12 months of launch, they hit $42.5 million in ARR, growing 30% month over month. This rapid revenue growth led to a massive $125 million Series A. Pricing had a role to play here. Clipfolio, an analytics dashboard for SaaS, initially charged per user, But then they realized this model hindered SMB adoption, so they redesigned pricing around other value metrics and then moved to unlimited users. This gave them a lot of adoption and stickiness. So when they approached investors, they could prove the stickiness and retention and make that as a basis of the fundraise. Number three, MongoDB. They shifted from a traditional open source model to their Atlas cloud offering with consumption based pricing. And they were one of the earlier ones to do this. This innovation allowed them to monetize previously free users and drove their valuation from 1.2 billion to 27 billion in just 5 years. So it was about aligning pricing with database usage, a metric that correlated with customer value. And then Snowflake. Snowflake revolutionized data warehousing with their compute-based pricing model, and they separated storage and processing costs. This directly addressed customer pain points around the unpredictable costs of traditional data warehousing. This pricing transparency and customer alignment helped them secure a record-breaking $3.4 billion in Series G round and later a $33 billion IPO. At that time, this was the largest IPO. Next, Figma adopted a freemium model with the team-based packaging structure that fueled viral adoption amongst designers while creating natural upsell opportunities as teams grew. This strategy delivered 157% NDR and drove their $10 billion offer from Adobe. So in all of these stories, the metric, how the packaging was done, is very consequential in the success of these businesses. Now, what do VCs say? What do VCs think about this? Benchmark Capital's partner Sarah Tawel emphasizes that the companies that have poor pricing models miss opportunities for expansion and revenue, forcing them to later overhaul pricing strategy and delay future funding rounds. Sequoia's Mark Vernal evaluates pricing power during due diligence by assessing whether customers would still find a product valuable at higher price points. He has noted that startups often underprice their products, leaving significant value on the table, and I have seen this countless times as well. He points to successful companies where enterprise customers willingly pay premium prices because the value proposition is so compelling compared to alternatives. So here are some common pitfalls to avoid. Number one, underpricing. Don't set prices too low. Don't be so fearful. You need to keep testing the price point until you reach a point where customers start to say, no, I will not pay. Until then, you should keep raising your pricing. Wrong value metric. This is obvious. If you have a value metric that doesn't align with how customers think, you're going to drive inefficiency in your sales process. You're going to have math being done by the buyer, and you don't want them to do math more than which is natural for them. Overcomplicating pricing. If you make too many tiers and if you copy a competitor's pricing and think it's going to work for you, it may not, right? So don't overcomplicate things. You still need to have some amount of simplicity. And finally, you need to have an upsell path. Now, this is the opposite. If you are too simple and you don't have an upsell path, you don't have any add-ons, how are you going to have a good net dollar retention rate? So your packaging is directly correlated to net retention. So with all of these points, I'm trying to emphasize that we need to take a look at pricing properly, and it drives your valuation. So pricing matters during your fundraise. A good pricing strategy indicates to the VC that you're a good business person. It's not that you're just a good product person. It's not that you're just delivering value. They know that you are good at monetizing your customer base sustainably over time, and that's how you're going to make a successful business. So what actions should you take? First, treat pricing as a strategic priority, not as an afterthought. The average startup spends only 6 hours ever on their pricing strategy, yet pricing strategy is so important, you cannot afford to be the average startup. Second, align pricing with value. Identify what dimension correlates with customer success and choose a metric that is around that. Then build in upsell levers. You want to have add-ons. You want to have multiple pathways for customers to pay you more as their usage increases. And finally, iterate on pricing. I cannot stress this enough. People just look at pricing every once in 2 years, but you iterate product every other quarter or every month. That's not going to win. So you need pricing that iterates. Pricing is a thing that lacks dependencies from other things, but it's such a powerful lever for you. So I recommend you please please focus on pricing and use this leverage as part of your fundraise plan. Even a year before fundraise, you need to fix your pricing and show these metrics to your VCs, so that instills confidence in your business. Move away from the mindset of, I will just demonstrate that the customers are getting value and VCs will be convinced. That may not be the case. Thanks so much for your time, and I hope to see you in the next video.